Last week I was traveling to Mumbai and I had visited my colleagues at Upsurge and further interacted with some brokers, one by the name of Punch in Mumbai and of course even Grow as brokers subsequently paid a visit to me at my residence. So last week I had been quite busy, and which explains why I could not upload the videos that I had been uploading previously. Having said that, during the course of the week, I must acknowledge that when in the initial days I did not post the video, I felt that I'm missing out on a daily routine, which is a unique development in that context. And also I received messages from a few of y'all, and I asking me about my health and in general asking me as to why I could not upload the video. So I appreciate those very kind messages, and as usual I will try to answer the questions that have been asked in the comments, maybe with some delay. So we'll come back to where we were some time back, and as discussed, that in order to improve as traders we need to first fix certain parameters. And if our decision is to use technical analysis, or let's just not use the word technical, let me replace it with mathematical and statistical tools, in order to create a trading bias and to create a trading plan which is a function of the trading bias, then one of the keys is to fix those indicators and the role they have in your overall assessment and analysis of the market. So we'll come back to the chart at hand. If you all remember earlier, we had discussed while we were at this point in the market. This is where we basically, this was where our last video was perhaps recorded. At which point you would note that we were seeing an uptrend in the market, and we used the pullback in order to buy into that uptrend. And by the time we took that, we trailed the position, we had an SL of 23,400, which obviously got traded the subsequent day when there was a gap down. And of course, after the gap down, we all know what has been happening in the market. There followed another huge gap between 22,900 all the way till 22,000, perhaps actually 22,000. So the market gap down roughly 750 to 900 points overnight. And since then, this is the price action and the manner in which it has unfolded. So once again, let us use our approach, our standardized approach, in order to create a bias. And for that, we will first select our indicator, which is ADX. And as has been discussed in the past, that only when ADX is above 25 can we say that the security is trending. And as we see here, that the value of ADX as of today is 29, which is greater than 25, which means that this particular security is of course trending. And now the question is, it is trending in which direction? It is fairly visually obvious to us also that it is trending, it will be downward direction, because obviously from a high of nearly 23,900 we are trading, we are let's just say 24,000, we are trading at 22,000. So there's a near 2,000 point correction in the market in a matter of a week. So we know from personal experience also that the answer will be downwards. But the reason why we are not using our own discretion is because we want to make the process mechanical, because we intend to improve this mechanical process. You see, it is very difficult to improve our discretion or our intuition, but it is much easier to improve and customize a mechanical process provided we are used to using something. So we will use the standard 20-50 moving average, and here we will see where the cursor is at, that we have the bearish cross. And after the bearish cross, we can see that the market has obviously trended downwards, and currently the market is pretty close to its 20 period moving average. In other words, the trend is down, and therefore a trader would be incentivized to sell the high. After the gap down, there was obviously no sell, but once it recovered towards the 20 period moving average at this point, there is a potential that traders who were using this technique while I was not preparing the video might have been interested in shorting the market at this particular red line. we must understand what we are discussing. We are discussing the nature of a trending security on the hourly charts, and we understand that work done on the hourly chart will only be applicable for the same day. It is essentially a day trading technique. However, for the purpose of practice, we are looking at the charts in a continuous manner, wherein I'll just extend this line. We will see that our longs exited here, and since we bought at this particular line, the exit would have been at a loss of approximately 100 to 150 points. Since then, we would have not been traded, and if at all, we would have waited for a sell the rise, and that rise happened at the 20 period moving average, which is 22,500. And since then, the market has obviously traded slightly lower, and there is a holiday tomorrow, and the markets will resume trading day after tomorrow. But the objective is to use this method to form a bias, and based on what we are seeing, it becomes very clear that the security is trending bearish on the hourly charts. I hope this is clear to everyone that we have used simple ADX technique, and since ADX is greater than 25 as has been discussed, I'll just mention this once here. ADX greater than 25 equals to a trend. So this is how our algorithms in the future and our Excel sheets in the future, this is how we will recognize it. Simply writing ADX greater than 25, we already know that it is a trend. Generally, whenever it is a trend, we have discussed that it becomes safe to long the PE and the CE, that is to long the call and the put options. And the direction of the trend would obviously be determined from the 2050 MA cross, which is death crossover, implying that the trend is bearish. So to conclude, it is a bearish trending security on the hourly chart. Bearish trending on hourly, right? And if it is bearish trending on hourly, the plan is obviously going to be to sell the rise, where the rises are 20 and 50 period moving averages. Now, some of you all could argue that we do not get traded as often, or that some critical moves were missed, etc. So here I would like to add that let's say we change this 2050 moving average and make it to as say 515 moving average. It is possible then that you would have got traded and you would have captured a better move. In other words, even though there is nothing wrong with this technique, the variables that we have chosen in this technique are not very applicable to the current market type. This is all that it basically means. Then the question is, why am I choosing these particular variables, that is ADX 14 and 2050 moving cross? And the answer is that in general, these techniques are applicable, which means that if we do this long enough and we do this consistently for a long enough period, we should expect favorable results. So we have made our assessment on the hourly. A lot of students have also asked for a similar view on longer time frames, and that's largely because they say that they are working and they do not have the time to check the markets during the intraday hourly charts, which is very reasonable. We are only focused on the technique, and if the technique is simple and well understood, then I would encourage you to just simply answer the question as to what is the trend of the market on various time frames. So we have done the assessment on the hourly, where we identified that it is trending bearish. Let's move on to the daily and see. So on daily, as of now, we are seeing that ADX is at 24, and as we mentioned that ADX above 25 is equal to a trend, whereas ADX less than 25 implies there is no trend, right? And in fact, I had also mentioned that ADX between 20 to 25 will imply no trading. So here I will add it, ADX that is between 20 to 25 implies no trading at all. Why is that so? Because at this point the security is neither trending nor ranging. It is showing a tendency to either trend or range. We do not know yet, but the confirmation will come in some time, and that confirmation could be that ADX moves back above 25, in which case it is trending, or ADX starts dipping below 20, in which case we will say it is ranging. And as we discussed, that while for a trending market we are going to long the CE and the PE, for a ranging market we would write the options, which means you would short the CE and PE. And of course, as I have clarified on multiple occasions, that personally I no longer trade options. I basically create similar positions in futures. So having said that, now it becomes very clear that because ADX is less than 25, what we are looking at is that the trend is not strong, or there is no trend on the daily. In other words, there is a predisposition towards ranging, and when we are talking about predisposition towards ranging, we will look at the previous low, that is this value, and the previously created high, that is this value. Because ADX is below 20, is above 20, so we are not going to be taking a trade also. But let's just assume that the market flattens out for a few days, then this ADX value will start dipping, at which case it will become a trade for the swing trader to ride the 21,750 put and the 23,750 call. In other words, the swing trader is making a claim that because ADX is less than 20, that the market is likely to range between this particular zone. And we have already discussed this in the previous videos, that we are going to initiate this at the midpoint of the zone, which would be somewhere right here, 22,800, which means at the midpoint of the zone, the trader will sell the call and the put option of the high and the low of the range. Now you would argue that we are getting very less premiums, or that the strikes are very far away. You see that we cannot determine the strike of the contract that we are going to write. We can only look at the pivotal values and take a trade. And if there is an obvious pivotal value, first of all, you will find liquidity at those values. And if the volatility is high, you will get reasonable premiums for those particular strikes. And it is adjusted in the distance, the accuracy, which means wider the range, the higher the accuracy. However, you will get lesser pay. But if the range is very narrow, like for example, if we are only looking at this particular cluster, which I will mark here on a rectangle, for example, let's just assume that there was some ADX value here. If the range is very, very small, you will obviously gain a lot in terms of premium, but there is a full probability that this range will not sustain. So higher premiums will come at the trade-off of lower accuracy. So this is a part and parcel of one's trading process. As mentioned, that my personal view would always be to trade futures, and if I were using ADX as one of the parameters for selecting, at ADX 24 I would ignore this particular security for trading futures. So let's just move on to the weekly and do this assessment very quickly there. I will also in the meanwhile try to eliminate some lines. Just we'll give it a moment. So I think there is some issue with the internet. I will just try to connect it with the hotspot and see if there is something that can be done. Okay, let's hope that it works. So I will first eliminate these horizontal lines as we are seeing here, and I will for now just remove this text. And now let's have a look at the so I had selected the weekly. Let's just see if it allows now, because generally after it gets disturbed, it doesn't reopen to that. So I'll just refresh this. And one, of course, these charts are available at the broking platforms also. But because I consistently use this particular website when I'm analyzing the markets, so the values of ADX and certain ATRs and so on and so forth could change from platform to platform. By keeping our platform constant, we are likely to eventually hit onto the correct values. So the trick is to make sure that we do not make too many changes, and that we do not assign our failures in the market to charting platforms or algorithms, etc. The trick and that we do not juggle from one variable to the next on a regular basis. The idea is to ensure that we are consistent in our approach, and I'm trying to get the live chart for the weekly process. So I think it's taking more time than usual. I'm sorry that this is taking unnecessary time. So many free pop-ups, maybe that's why. Perhaps it pays to get a paid version. Extremely annoying, but I appreciate it if you all have waited for this long. The few minutes, they were agonizingly long for me because I was nearly approaching the end of the video, and this delay is just obviously a waste. So anyways, here we will look at the weekly, and we will see that the weekly is currently priced, the ADX is at 20.03, slightly higher than our threshold. We will wait for the week and see where the ADX value goes. For now, because the value is between 20 to 25, and we have discussed this in the past, that if ADX is between 20 to 25, we simply do not form an opinion and do not take a trade. The bias, of course, is towards the range, but we will wait for the week to conclude as of Friday. Today we are on Wednesday, and I think tomorrow is a trading holiday. So no trading activity on the week, no trading activity on the day. On the hourly, of course, it is bearish trending. And finally, I will just include this on the monthly time frame. And it is here that we are seeing that ADX is 36, implying that the security is indeed trending on this particular time frame. And if we want to understand that what is the direction of the trend, like we discussed, that the standard process would be to select the 2050 moving crossover, and this is what we will get. We will get that the market is at the 20 period moving average. The 50 period moving average as per this method is at 19,470, and because it is trending, we understand that we would want to buy a call option in this market because it is trending bullish on the monthly time frame. But practically it is very difficult to trade FNO on the monthly time frame. So let's assume there is a Nifty ETF, there is a Nifty there is a large cap fund which specifically focuses on Nifty 50, or the Nifty futures itself, because it has a direct correlation. In that case, what I would do is I would simply mark the 20 period moving average, and for example here I would select it with the slightly dark line here, and I would mark the 20 period moving average, which is 22,750, as my first entry. The market, of course, is trading a little lower than that value as of now. The 50 period moving average, which is now 19,000 approximately 500 pardon, I would start investing into the market, into this. Why investing? Because we are now on the monthly time frame, and I would invest till what value, at which point we include the final indicator, that is the ATR, and we will see that it is approximately 1350 to 1400 points. So if I subtract roughly 1300 points from 19,450, I will land at close to approximately 18,100, which would be my final SL on this particular position. So in other words, if I were an investor in the market, I would be using this, because the market is trending on the monthly. I would be using the monthly charts in order to buy the pullback. I would buy the pullback at the 2050 period moving averages, which I would update every month end. For example, this is the start of April. So logically my SIPs etc. would get triggered at this particular value, and they will generally continuously keep trading till they are trading below the 20 period and at the 50 period moving average. If the security is to dip below the 50 period moving average and to exceed it by 1 ATR, I will obviously I will leave the trade and take the loss as it comes. And we must understand that it is very difficult for the market to take the 50 period moving average. For example, the last time it tested it was in COVID, as we can see here. We can see this 14-month corrective phase in the market in the period 2015 to um, your 2016. This 14-month corrective period, this was on the basis of failed currency or currency crisis in Asia, and even here it did not trade the 50 period moving average. We can also see this phase, which is the Russia-Ukraine war. Russia-Ukraine war, it only stopped at the 20 period moving average. We are currently at a global geopolitical tensions due to tariffs, etc. So it is a reasonable hope or an expectation that the security is likely to stop around this particular moving average, because historically we can see that it behaves as a support. For example, pre-COVID also we will see there are several supports, and here we will see that the other time that this particular security failed this 50 period moving average is, now we can look at this phase. This is the subprime, the 2008 crisis. In other words, the 2008 crisis or a COVID crisis is basically where your investment positions will come to a close, and that is the reason why this stop loss is given in this manner, factoring the ATR, that it will trigger sometime in our trading careers. If we are unlucky, it will trigger at the time we start our trading careers or investment careers. If we are fortunate, the market will first run up for 3, 5, maybe 10 years and then trigger. But the only difference is that the moving averages would have trailed significantly higher and we would realize a more bang for our buck. And therefore, in my sessions and courses and lectures, I have always taught that identify on what time frame the market is trading, have a clear understanding of what are the costs associated with trading, and use that as an input to determine the time frame in which you want to trade and the securities that you want to select. Of course, it is not the only approach. There are many other reasonable approaches also to trade, but this is one of the approaches that I have shared, and such are the logics behind this approach. So I hope that despite the issues with the internet, this video would have contributed to your overall understanding of these indicators, and I will see you in the subsequent videos in the future. Thank you for your time.